India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning, hello and welcome to Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Niva Bupa. With me, my colleagues Nigel D'Souza, and today we have Rima with us in the studios. And we're waking up to slightly, should I say, softer cues.
Yeah.
But guys, thank God it's Friday.
Well, that's right.
It's Friday the 13th.
Yeah, indeed.
Yes.
But I think there's one word that India's chanting since yesterday, right? Gukesh.
Absolutely.
It's a historic triumph,
Yeah.
the youngest ever world champion. It's an indescribable feeling of pride.
Absolutely.
For all of us watching from the sidelines.
Oh, absolutely. It was quite a stunning win, and for him to do it, I mean, literally a child prodigy of sorts, the youngest to win the World Chess Championships, and the only second, I think, Indian after Viswanathan Anand to have done this. It's a matter of immense pride for this young man, for his family, and of course for the entire country, the country that he represents. Extremely happy and proud this morning, all of us, I'm sure.
Well, that's right. And, it tells you, right, a few years ago, he said he wants to be champion. He persevered, he, put in the hard work. And yesterday, he got that opportunity, that window of opportunity, and just seized it. A start of a new era. And in fact, the new champion on the screen. Emotions running very, very high. And, even after the game, I think he looked out and he set up the board yet again.
Yes.
So, that's what a special feeling for every Indian. Well done, young man. A new era, so great.
Absolutely.
But back to the markets, and it was a losing Thursday for US markets.
And that's running off on Wall Street as well. I mean, we are waking up to really challenging cues from the global standpoint, because there's been this wide sell-off on Wall Street, and Asia is kind of picking off on some of the markets on your screen. For instance, Hang Seng is down almost 2%. So what's caused it? Well, primarily blame it on the US wholesale inflation number, because this producer price number that came out yesterday, it was above market expectations. The November PPI is at 0.4%. Expectations were that it will be just about a 0.2% increase. And even if this is, of course, month on month, even if you look at the year-on-year comparison, then at 3%, wholesale inflation has come in at the highest rate since February of 23. So this inflation print got the market spooked. On the equity side, it meant a wide sell-off, and actually a much bigger sell-off in the Russell 2000. The Russell 2000 was down almost 1.5%. The Dow and the Nasdaq, S&P, they were down about 0.5% thereabouts. So, big fallout in terms of US equities. But even in bonds, look at the way the yields moved. Immediately after this print, the 10-year popped up by almost 6 basis points. Even the US 2-year yield, that moved up by 4 to 5 basis points as well. And we'll pull up the 10-year right now. It's around that 4.3% handle. So yields have moved higher. The dollar moved higher. The dollar index, as we can see, has now crossed again 107. So these are sharp moves that have come in overnight. For the dollar, the added sort of issue was the ECB rate cut. The euro anyway had moved lower because the ECB is cut by 25 basis points, which was along expected lines. And now the focus is entirely on the Federal Reserve. Before this inflation print, the probability of getting that 25 bips cut from the Fed was about 67, 68%. But now that probability has moved much higher. So it's all eyes on central banks. ECB has done it. Fed is expected to do it. And the BOJ, a lot of people are saying, could be actually on hold. Even the BOJ, Bank of Japan, is meeting next week. More macros to track here in India. And actually, we're better off because from a macro standpoint, we have good news. We have inflation coming down and we have IIP picking up. So the number that we got on CPI inflation for November, from that pretty ugly looking 6% plus, we've at least come down to about 5.5%. So that's the good news. And food inflation has cooled off, not as much as perhaps what one would like to see, but still it's down to about 9% right now. The IIP number has shown a marginal uptick. It's not a sort of a big bazooka IIP, but nonetheless at about 3.5% versus 3.1%. So that's the good news. For the market, what we've seen is consolidation this week. And the reason I'm looking at it positively is that in the week of consolidation, the zone of 24,500 to about 550, that's held beautifully. It's not broken. Now, the problem is overwhelming negativity in terms of global cues. Otherwise, next week is Fed. and we're going in with the expectation of this 25 basis points cut. Whether the market starts taking some positioning, you start lower with a gap down and maybe then build on it, we'll see. But yeah, we'll have to see if India can be an outlier. Otherwise, it's a deep sea of red today.
Indeed. US markets, I think, are down now for the 6th day in a row. The Dow, and week to date, the Dow Jones is down close to about 1.5%. But back home, as you said, right, it's been so much of consolidation. It's 5 trading days of lackluster sideways move without any big directional bias. So markets have been pretty much in the range, that well-established range of about 24,500 on the way down to 24,850 on the way up. Only yesterday, after that initial pop, markets started gradually grinding closer to the lower end. This 24,500 is going to be an important support for our markets because that's where the Nifty 10-day exponential moving average, the DEMA, is placed. So 24,490. The small cap index, till Wednesday, even if the Nifty was, consolidating a bit of a negative bias, the broader markets were outperforming. But yesterday, the mid-cap index fell in line with the frontliners. The small-cap index snapped a 14-day winning streak. In terms of flows, well, it's the same picture all over. The FIs sell. They sold about 3,560 crore in the cash market. The DIIs pumped in 2,646 crore. And just a little more, some more on the Asian market picture because it's firmly in the red now. So, Subi spoke about Hang Seng, but even pull up a Nikkei, that's down 1.5%. You've got Taiwan, which is also open mildly lower. So across the board, there is red on the Asian market screen. Shanghai is also weak. And even yesterday, the press conference coming out of China, again, it's giving you a positive sentiment, but it's lacking any fresh policy details, any big stimulus that's coming out. That bazooka was again missing, and that's sort of disappointed, investors and traders alike.
Absolutely. Well, that's right. All the cues that you're stating perfectly ties in with Friday the 13th, right? You have the Asian markets are under pressure. You have the Dow that's lost out for the 6th straight session. And you have the dollar index, which is a very, very important cue. Well, that's at around 107 odd. So the cues are perfectly stacked up for Friday the 13th. Query is that whether or not the bulls can surprise and in fact, fight back at some time during the trading session. We'll see how that goes. Well, moving to yesterday's trading session, there was unwinding of positions, particularly on the Nifty Bank because the open interest was lower. You had the Nifty as well that had open interest lower. So there was unwinding of long positions is what we saw. And in terms of, the FI data, well, that perfectly collaborates with this because the long positioning was down by close to around 20,000 contracts or thereabouts. Shorts, well, it was mildly lower and the long positioning now has come down to around 40%. So in short, in the last few trading sessions, the absolute number on the net short side has just moved up. So it was at around 45,000 contracts. That's moved back up to around 70,000 contracts. So shorts getting into the system. That's as per script. That's something that we like, right? There's some shorts in the system. And the clients, well, they have gradually rebuilding their long positions. They had booked some profits, and that's gradually moving up. Just one point, last Friday, we had made this point, you have a big RBI meet, and it wouldn't hurt anyone to take some money off the table. I think that calls worked pretty well because you have not lost out at all, and the index has gone absolutely nowhere. Moving to the options data then, the 24,600 call, 24,600 put, both of them were fairly active in trade yesterday. Someone is playing a short straddle, then they're looking at pocketing 300, 350 rupees odd, and they're playing for a wider range. But since that 24,600 put had a fair bit of open interest build up, the premiums around 170. I think that 24,400, 24,450 becomes an extremely crucial mark in terms of a support zone. So that's why I'm saying the support zone is in this vicinity of around 24,400, 24,450. We have the 50 DMA closer to those levels as well. So that's why that's important. On the upside, I think 24,900 marks becomes a bit of a resistance zone. Stock that I'm looking at is Nalco. Yesterday, there were big shorts that got built into the system. That's because of alumina prices cooling off. But when shorts are already in the system, the stock has now moved into the F&O band. So it falls only when you see cash market selling. So we'll have to see whether or not the shorts get trapped on the wrong side because now you cannot do any fresh shorting on this one. Massive open interest build up is what we saw on this counter. So I'll keep an eye out on Nalco.
Okay, thank you very much for that. Let's get to the equity calls then. Mahesh Nandarkar of Jefferies says the investment cycle has now entered its 5th year and it should go on for another 4 to 5 years. He says after strong EPS growth and market returns over the last 4 years, expectations are moderating. He says EPS growth has slowed to less than 10% in FY25 and he expects a 13% EPS growth in FY26 or calendar year 2025. He says domestic flows remain strong, but equity supply has caught up, capping market returns. Their December 2025 Nifty target of 26,600 implies a 10% total return. They are overweight banks, telcos, two-wheelers, healthcare, real estate, IT and power.
Okay, all right, that's a call from Jefferies coming through. Let's move on and say hello to our first guest on the show. We have Ben Powell, Chief Middle East and APAC Investment Strategist at the BlackRock Investment Institute, joining in. Ben, good morning. Great to have you on. So let's start with China, actually, because, this was once again a hyped up, well-tracked meeting, this economic conference. But one is not sure what exactly has come out of it, apart from promises of bolder reforms, bolder policy measures. Your thoughts and your view on the market there?
Good morning. Great to be with you. Yeah, that's exactly right. It continues to be 1,000 water pistols in China and no bazooka. So another kind of version of this. And I think over the last year or two, markets have become increasingly unconvinced by policymakers. So the reality is that it's very much a case of show me rather than tell me, meaning I think markets are going to be reluctant to buy into speeches and rhetoric and promises. And we're very much going to wait for policy delivery, specifically fiscal stimulus targeted at unleashing Chinese wallets. Chinese households have got lots of money, but they've also got lots of anxiety. So that money for the moment is staying locked up. The question for 2025 is, can policymakers create a confidence recovery? If they can, there's quite a good story, I think, in China. But again, confidence, that's easier said than done, and we're not quite there yet.
Hi, Ben. Good morning and good to see you. Ben, the last time we chatted, you told us maybe these FI outflows out of India could be abating, and that's happened. So good on you. And you were more positive on India than China. So that as well has worked out pretty much in favor. Now, getting back to the central bank action, yesterday we saw some easing from the ECB, the Swiss bank as well. All eyes are on the Fed now in the coming week. And because of a couple of data points, now some part of the market is a little bit nervous whether or not the 25 basis points will come or not. Though the Fed futures are indicating that's a done deal. Do you think that they could skip in the coming meeting, that rate cut that the street is anticipating?
I think they're going to cut next week. So the Fed normally doesn't like to let the market down. So once the market is fully expecting something, which, as you rightly observe, is the case, the market is really expecting a cut next week. So if the Fed doesn't deliver, that would be kind of a needless shock. So I think the Fed will follow through. Longer term, meaning I guess through 2025, there is still an inflation battle which is ongoing. That war is not over. Inflation continues to be sticky. In our view at the BlackRock Investment Institute, that's driven by structural forces. And we think that's going to give the Fed relatively little room for maneuver. So next week, to answer your question, clearly we think, yes, they're going to cut. But 2025, probably they can only do maybe 2 more cuts to get down to 4%. And then we think they're going to kind of be stuck because inflation continues to be a bit of a problem more than they would prefer.
Ben, do you think 2025 is going to be as strong for the U.S. equity markets? Because they were the standout, market this year in terms of corporate profits, economic strength. Will 2025 be as good?
We think so, yes. We've actually, in our 2025 global outlook, we at BlackRock, the world's largest investor by far, we've actually just increased our US overweight from +1 to +2. So we, while mindful of valuation, of course, valuations do look a little expensive. I think that's true, and I want to acknowledge that. But it seems like the excitement around, let's say, the combination of the deregulatory fervor with the new administration coming in, they seem to be maximally pro-business. We had President-elect Trump on the floor of the New York Stock Exchange yesterday, high-fiving traders and market participants. This does feel like a very different situation. So that combination of deregulatory enthusiasm and the ongoing AI megaforce, which is, it's not just in the US, but it clearly is centered in the US. we think will continue to give US equities pretty potent tailwinds. So yes, we think 2025 should continue to be more of the same, more good news for holders of US equities.
Okay, all right. So more of the same in 2025. Got it. And we will want to have more of you in 2025 as well. Looking forward to more conversations. You have a great end of the year.
To you, thank you.
Thank you. With that, let's move on and talk about macros here at home. While the inflation print spooked to Wall Street, we have better news here in India because inflation has finally cooled off. This is, of course, CPI inflation has cooled off from that 6.2% mark to at least coming down to about 5.5%. And there's some cheer on IIP because IIP has picked up compared to the previous month as well. Lata is here with all the analysis. Lata, what do you make of the numbers?
In line with expectations is always good because it's 5.5, lower than October, 6.21, and lower than that 6% dreaded mark, which is the upper tolerance limit of the RBI and the MPC. So far, so good. Now, where do you think the problem starts? Okay, the other good point really is core inflation. Core inflation is a little bit lower than October at 3.6% versus 3.7%. That's largely because gold prices fell. So that's helped. And that's the good news. Now, the slightly troubling news, food inflation is still at 9.04. It's better than 10.87 of October, for sure, but not as low as analysts were penciling in. And within that, vegetables, yes, 29% year-on-year looks ugly, but it is so much better than the 42% year-on-year rise, which was the October number. But it was expected to be even lower. It was hoped that it'll fall more in December as winter sets in. But the first 10 days December data is not all that encouraging. Besides, in November itself, you have edible oils running at 13.5%. It wasn't expected. You know, the import tariff increase, which brought this price increase, was expected to be restricted more to October and not so much in November. That's come in higher than expected. And cereals, it's almost 7%, 6.9%. That's not good. You know, these are very, very essential staples. And if they still run at 7%, it's very, very troubling. So overall, the food inflation is not very encouraging for the governor. For the new governor, there is one more number. December inflation before he gets into the monetary policy in the first week of February. Now, that number, the Reserve Bank's October, November, December average forecast is 5.7. We have a 6.21 and a 5.48 for the 2 months. If the December month is even 5.6, that forecast of 5.7 is achieved. But you tell me, a governor going into a first policy has 6.2, 5.5 and 5.6 December inflation. I mean, what is the confidence with which he will cut? He'll perhaps cut by pointing out to 6 month ahead inflation and saying, no, we expect it to be 4%. But it still makes it slightly shaky ground. And what is making it even more shakier is the way in which the dollar is rising. 107, which means we are going to see perhaps a little more upward pressure on the dollar rupee as well, maybe already at 84, 85. And as you go towards February, if it, Trump is already in the presidency, if it gets ugly, there is a lot of imported inflation coming in if you have the rupee at 85 or 85.5. And I mean, I would still think that the governor has a tough spot. Already 2 external members are voting for a cut. So it's very easy to get a cut, both in terms of the numbers he has and pointing to the IIP number, which is what I'm coming to. IIP, we're all saying, oh, it is in line and it's a little better than September number. But 3.5% for a country aspiring to 6.8 to 7% growth. And this is, remember, October, when factories are producing everything for the festival month, both October itself and November. And still we have only 3.5. And look at all the goods. Consumer durables is the only thing which is a tolerable 5.9. Non-durables, which you will consume during Diwali, 2.7. Capital goods, 3.1. Electricity, 2%. Manufacturing, 4.1. I mean, it's not really a gangbuster growth. The governor will probably point to this when he asks the MPC members for a rate cut, probably. But, this is not overall a very cheerful number. As far as growth is concerned, as far as inflation is concerned, yes, it is leading to a rate cut.
Thank you very much for that. But as you said, right, before his first meet, Trump would have taken charge on the 20th of January. So there is that uncertainty, dollar index.
Let's not only look at inflation.
It's not just about inflation growth back home. but it's also about, trade tariffs, what Trump will do. But we'll talk more about it as the show goes on, as the day goes on. Let's tell you what the corporate interactions are that we've lined up for you on our show today. So first up at 8:35, we'll bring you an exclusive conversation with the management of Niva Bupa on the health insurance sector. At 9 a.m., we'll talk about the rally in IT stocks. Sandeep Agarwal of Sovilo Investments joins in. 9:20, Pankaj Tibrewal of Ikigai Asset Manager will be our key market master of the day. 9:30, we'll shift our attention back to the insurance space as the insurance regulator considers tightening norms to curb over-dependence on bancassurance channels. We'll be joined by Nilesh Sathe and Rajesh Sood. And following that, some market action. International Gemological Institute, IGI, the IPO opens for subscription today. We'll get chatting with the management at 9:40 to talk about their prospects. At 9:50, Rajat Rajgarhia, Motilal Oswal will join in for some market talk. And towards the end of the show, in our special segment, It's the Economy, Lata will get chatting with Abhishek Upadhyay, ICICI Securities Primary Dealership, and Upasana Bharadwaj of Kotak Mahindra Bank to discuss the November inflation numbers and the chances of a rate cut in February.
Well, time to slip into a short break. We've got a lot of stock-specific action that we're tracking for you in our special Top 10 segment. For the time being, I'll run you through the list. We're looking at HAL, L&T, Power Grid, Tata Motors, Ashok Leyland, JK Tyre, Optimus Infracom. All of them will be reacting to positive news flow. On the flip side, Zomato, Kalpataru Projects, and Greenply could open up in the red.
Welcome back. You're watching Bazaar Morning Call. It's Friday the 13th. We're excited because it's Friday, but the global cues are subdued. U.S. markets ended in the red, down close to about 0.5% lower for the sixth trading session. And Asian markets this morning are under pressure. GIFT Nifty is down close to about 100 odd points. Our research team is now standing by with CNBC-TV18's list of top stocks for the day. And let's welcome Mangalam first, and he's going to be telling us the news on Zomato. Mangalam.
Well, so Zomato's received an order of tax for about 401 odd crores from Maharashtra GST for a period of October 2019 to March 2022. Along with that, there is also an interest and penalty of a similar amount, making the total demand to around 802 odd crores. The company, on its part, has said that they have a strong case backed by opinions coming in from external legal and tax advisors, and they will appeal against this order. But just this uncertainty around tax may keep the stock mildly in the red. However, remember, these things typically take a long time to play out, and as a result of which, that mild red may perhaps be looked at as the street as a buying opportunity, largely because we're also entering December, which is a heavy food ordering period.
Okay, so Zomato is going to be in focus. Let's see what they do about this 800 crore PE IT notice that they've got. Mangalam, thank you very much for that. Let's move on. Vivek is watching out for a bunch of stocks. I think he's watching out for HAL, L&T and Power Grid. Good morning, Vivek.
Well, good morning. HAL and L&T on the back of significant order wins as far as the Ministry of Defence is concerned, and Power Grid too on the back of an order win. Now, when you're talking about HAL, Ministry of Defence has signed a contract worth 13,500 crore rupees. This is for the procurement of 2 Sukhoi aircraft. Now, when you're talking about this particular order win, it takes the YTD order intake in the manufacturing segment to over 39,500 crore. Now, talking about L&T, this company too has received an order for manufacturing 100 K9 self-propelled howitzers. The likely order size, as per what the reports are indicating, is that this particular order is close to 7,600 crore. So this means that L&T in H2 should be able to comfortably go ahead and meet its order inflow guidance of 10% growth on a year-on-year basis. Now, coming to Power Grid, the company has emerged as the successful bidder or the lowest bidder under the TBCB, which is the tariff-based competitive bidding, for 2 projects. Now, this is for interstate transmission system projects, and this particular project will be executed under the build, own, operate and transfer model. One particular project is for developing a 400 kilowatt transmission line in Tamil Nadu. The other project indicates that the company will build a 400 kilowatt transmission line in the state of Karnataka, expecting a green in all of these stocks today.
Thanks a lot for that, Vivek. Well, let's wind this down with Sudarshan, who is here to tell us about some more stocks that he's tracking, particularly from the autos and tire space. Sudarshan?
Good morning, Nigel. So first, we'll start with Tata Motors. Company has decided to take a price hike for commercial vehicle segment, and that price hike will be in the up to 2%, and it would be effective January 1. Remember, on December 9, company had announced a price hike for passenger vehicle segment also, and this price hike is taken because of a rise in input cost. Next is Ashok Leyland. Company has bagged order of rupees 346 crore for Tamil Nadu government, and this order is to supply 1,475 diesel fuel type passenger buses, and order will be executed till May 2025. Last is JK Tyre. DEG, that is a financial institution company, will be providing long-term loan of rupees 270 crore, and this fund will be used to expand the unit at Madhya Pradesh, and total cost for this unit is around 1,010 crore that company had announced earlier. So overall, these 3 stocks will be in focus, and I'm going with green for all 3.
Thank you very much for that. It's over to Vamakshi now for some more stocks that are in the news.
Well, absolutely, Reema. Good morning. Optimus Infracon is the stock that I'll be watching out for, and that is because the board meeting was held yesterday, and they've gone ahead and approved preferential issue of up to 21.85 lakh shares at an issue price of 672.25 rupees per share for an aggregate amount of 147 crores. They've also approved allotment of up to 42.7 lakh fully convertible warrants at an issue price of 672.25 per warrant. This can be converted within 18 months from its allotment date into an equivalent number of fully paid up equity shares for an aggregate amount of up to 287 crores. So going with the green for this counter. And lastly, let's also focus in on Greenply Industries, going with the red for this counter because they've closed manufacturing operation at its ARMS Vadodara based MDF plant due to breakdown of machinery. They say that necessary steps are being taken in order to resolve the issue, and the facility is likely to resume production over the next few days.
Okay, all right. Some disruption maybe in their, immediate plans. Got it, Vamakshi. Thank you. Excuse me, thank you for that. Back to Abhishek then. He's watching out for Kalpataru projects. Abhishek?
Well, fundraising spree continues amongst many companies that are listed. So, sources do tell CNBC-TV18 that Kalpataru Projects International has launched a QIP. The QIP size is about 1,000 crore and the indicative price is about 1,201 per share, which is at a discount of nearly 6.5% to yesterday's closing price and about 1.2% to SEBI floor price. The equity dilution would be about 5.1% of total equity. The use of proceeds that they have mentioned in the term sheet is to repayment of certain borrowings that they have done and general corporate purpose as well. They have a lock-in of 30 days for the promoters post the QIP, and the book running lead managers are ICICI Securities as well as Aventus. Back to you.
Okay, all right, Abhishek, thanks a lot for that. Well, let's do a quick recap of all the top stocks that we're tracking for you. The ones with positive news flow: HAL, L&T, Power Grid, Tata Motors, Ashok Leyland, JK Tyre and Optimus Infra. All of them will be reacting to positive news flow. On the flip side, Zomato, Kalpataru Projects and Greenply Industries will be reacting to negative news flow. Tell you what, we slip into a short break, come back. Sid Khemka of Motilal Oswal Financial Services is waiting for us. We'll get into some further fundamental analysis on all of these names. Welcome back. You're tuned into Bazaar Morning Call. It's Friday the 13th, but maybe it may not be such a bad day. So let's see how the day plays out. But to help us out with some fundamental analysis, Sid Khemka, Head Retail Research, Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Good morning, and thanks a lot for joining in. Everyone's a little bit fearful this morning. Friday the 13th, the Dow on the 6-session losing streak, dollar index at around 107. I don't know whether or not, the bulls can pull out the rabbit from somewhere and, in fact, pull back in today's trading session. So let's see how that goes. Let's talk about stocks, though, Sid. HAL, they won a big order of around 13,000 crores or thereabouts. Street will be quite excited about this. What's your view?
Good morning, Nigel. Yes, everyone fears Friday the 13th. And we have in the last month of the year. But we definitely started on a good note. Congratulations to everybody in India on becoming the world champions, and especially to Gukesh. I think commendable journey there. Youngest ever global, you can say, world chess champion. So a positive note to start the day with. In terms of HL, yes, I think what we are seeing is that the government activity has definitely increased in terms of ordering, not only in the defense space, but also some of the railways, road projects, other projects. So that is a very positive step that the markets would be taking positively. In terms of HL, I think it's a very positive development. The company will supply 12 Su-30 MKI aircrafts along with the associated equipments to the Indian Air Force, deal worth more than 13,500 crores. So in terms of the order book, in terms of delivery, I think there is no doubt in terms of the capabilities that HAL has. Now with the cool off in the stock price is done, I think from here, HAL, along with some of the other defense companies like BEL, Mazagon Dock, should do well going forward.
I think UBS has come out with a note on HAL, and they say the order value is 13,500 crore rupees, that we know. The indigenization portion is 62.6%, and now year to date, HAL has received manufacturing orders worth 40,000 crore rupees. So the order pipeline is only swelling for Hindustan Aeronautics. In this month, the stock is up close to about 10%. Siddharth, hi, morning. The IPO action has been red hot this week. We've got Vishal Mega Mart, IKS. Today you've got IGI, the International Gemological Institute, the one which certifies diamonds, studded jewelry, and diamonds both natural and lab grown. That opens up for subscription. Any of these IPOs where you're anchor investors or you're recommending to retail investors?
If you look at Vishal Mega Mart, we had a subscribe rating to the IPO. It looked like a one-stop destination for the value garment segment, the lower middle income group. The company has been doing a very strong expansion, especially focused towards the tier 2, tier 3 towns. Very strong financials. So last few years, revenue growth of 26%, net profit growth of more than 50%. So I think it's a good business, both from a listing gains as well as from a long-term perspective. I think that's something that we have been liking a lot. The other one that we are looking at is the international gemology business that institute, which we believe again one can look at from a long-term investment perspective. The company is a market leader in the industry. It is an acquisition of the IGI Belgium as well as Netherlands, which will make it the world's second largest independent certification and accreditation service provider for diamonds. We know India is a large market for jewelries, and the contribution from studded as well as the diamond business is only increasing. And with more awareness, the requirement for certification would go up. Financials also pretty steady. Revenue grew at about 32% in the last 2-3 years. EBITDA margins, very strong margins of 70%. Return ratios pretty strong. Hence, we believe these two IPOs from the current market, Vishal Mega Mart as well as International Gemological Institute, can be subscribed from an investment perspective.
Just one clarification, Siddharth. The India margins of IGI are 70%, 72%, as you correctly said. But once it consolidates Netherlands and Belgium, which are more high-cost, facilities, the blended margins will drop down to 59%. And when we asked the management about that, the drop in margins once you consolidate these international hubs, they said, well, you need those for your sales. So the blended margins going ahead should be closer to 59%, but that's very, very strong.
Got it. All right. Sid, just one quick word. IDBI Bank, the stock is corrected, I think, from around 110 to around closer to around 80. Now, it seems there is some optimism that maybe, in fact, that divestment could get pushed through. Any view on the stock since it's corrected from the recent peak?
Nigel, I think the story there, the key trigger would be the divestment and who's the new bidder who can come and take up the business. And that clearly remains the key trigger. Even earlier when the news flows regarding the stake sale were up, the stock was up. So I think at this level, yes, one could definitely look at, not from a business perspective, but purely to play out this event of the divestment and a new owner coming in and trying to improve the business going forward. Apart from that, I don't see any triggers from the core business perspective.
Okay, so in the near term, risk reward could look favorable, though that the big trigger will be continue to be divestment. Sid, stay with us for a bit. Let's shift focus and shift our attention to an exclusive conversation now. Niva Bupa Health, in their first television interview since listing, they have told CNBC-TV18 they're expecting higher than industry growth for the coming fiscal. Yash Jain spoke to Mr. Krishnan Ramachandran, the MD and CEO of Niva Bupa Health, to talk about the health insurance sector and the business momentum that they foresee. Let's listen in to that conversation.
On a full year basis, as of H1, the health insurance industry grew at about 17-18%. On a full year basis as well, is that our expectation that the industry on a like-to-like basis will continue to grow at 17-18%. Our H1 growth was about 32-33%, on a like-to-like basis. And by the time the year is done, you can continue to expect us to grow, I'd say 8 to 10 points, at least faster than industry on a like-to-like basis.
By FY25, which means accommodating for the second half, are these two numbers possible? I am just going by how you've grown in the recent past and normalizing it. 5,000 to about 5,200 crore as far as NEP is concerned, and about 6,300 to 6,500 crore on the GWP side.
See, on a like-to-like basis, our GWP number would be upwards of 7,000 crores, Yash.
Okay.
So, we did 5,600 crores last year. As far as GWP is concerned, on the same accounting basis, our GWP for the full year should be upwards of 7,000 crores.
At what point, in your sense, does growth start aligning with the industry? At what number do you think that the size is good enough for the growth to start aligning to the industry, according to you?
I'd say in terms of growth aligning towards industry, that number is probably when we get to upwards of 15,000 crores, Yash.
Okay.
I think at that point you can start to expect us to grow. Even then, I would wager that we'd probably grow faster than industry, but if you have to sort of put a number to it, it would be upwards of 15,000 crores.
Slightly longer term view, 10,000 crore of GWP in the next 2 years and 10,000 crore of NEP in the next 3 financial years, possible?
10,000 crores in the next 2 years, plus minus 5% possible.
So one question as far as expenses of management is concerned. At the end of H1 FY25, that stood at about 40%. We all know that the regulatory compliance requires you to bring it down to 35%. I believe you've put in a word, a request with IRDAI to give you some time to comply with that. What is that time limit that you've sought from IRDAI?
What I can confirm, again, on a like-to-like basis, is that by FY26, we are on the path to compliance. Obviously, there's a change in terms of the accounting. So we have submitted our position to the regulator that there has to be an adjustment for the accounting change. But on a like-to-like basis, we are on the path to complying by FY26.
FY26, the expenses of management comes down from 40 to 35%, as you stated. That 5% of reduction in the expenses of management ratio, how would that translate in terms of quantification on the combined ratio?
Got it. So let me, so as of FY24, our expense of management ratio, Yash, was 39.1. And there was about, roughly, if you look back at the last 3 years, there's been a 200 basis point improvements, 150 to 200 basis point improvement year on year. So FY26 as a standalone company, the expense of management limit for us will be 35% plus allowances for insurtech expenses for, incremental rural business. So, from 39, which was last financial year, we need to come down to, let me say, 36. Steady state basis, and I'm not saying that we'll get to this combined ratio next year. On Indian GAAP, as it stands today, again, we need to work our heads around the accounting. Steady state, you can expect a combined ratio between 95 and 96%.
What do you expect for FY25 as far as combined ratio is concerned? What would be the target? And FY26 and FY27, is there any target internally within the company in terms of how much ideally do you want to reduce combined ratios each year?
So Yash, for this financial year, as far as this financial, last year we were at 99% combined. And last year we had a higher level of seasonal infection, so the claims ratios were higher than the previous year. One of the big reasons was a high level of seasonal infections. This year, we've had seasonal infections, but it's been relatively muted compared to last year. So we do expect our combined ratios to fall well below 98% by the time this financial year is done. And as I stated, the journey to a 95% combined ratios is over the next 3 years, we should get to a 95% combined ratio on an Indian GAAP basis.
About 95% of the shareholding of the company is with institutions. These are FIIs, DIIs, and Bupa Singapore and Fettletone put together. There was, of course, the lock-in, which opened for 50% very recently. If you could give the street some idea in terms of which were the anchor investors, which sort of tendered their shares as far as that lock-in was concerned. And particularly with Bupa Singapore and Fettletone. Currently, Bupa holds about 55.98%. Fettletone owns about 17.47%. What is the kind of stake that they want to keep over the next 2 years, and how much do they want to divest and value unlock in the market?
Sure. In terms of Bupa, it's a simple question, Yash. Bupa is a very long-term shareholder. Bupa may increase shareholding from where they are over time, but they do not intend to bring down shareholding below the 56% that they already are at. As far as Fettletone is concerned, they are private equity. So over the next 2 to 3 years, again, they are not in any rush. They are a long-term shareholder, but over the next 2 to 3 years, you can expect the 17.5% to come into play, into the market. So that's as far as the Fettletone is concerned. In terms of the book is concerned, yes, we do have very high quality names in the book. To your specific question on, has any anchor, I don't believe so. We don't have the data yet. We get the reports, 2 days after. But if I just look at today's trading volume and value, I don't believe there's been any sale from any of our anchors.
The group of ministers recommending largely 3 suggestions when it comes to GST on health insurance. One is complete exempt for senior citizens. The second one is complete exempt for sum assured under 5 lakhs. And the third one being bringing it down to 18% to 5% for non-senior citizens. I just want to understand from you, what are your expectations in terms of what could be the final structure that could come through in terms of a combination of these 3? And would you be able to pass on the entire benefit to the eventual policyholder in terms of that mark-to-market cut which comes through?
Yeah. So Yash, the recommendation from the industry and my strong recommendation on 2 grounds, right? From an affordability standpoint, 5% does serve an affordability objective. Exemption does not serve the objective of bringing down prices, because it means that we do not get credit for inputs So effectively, exemption means that it actually increases costs from our standpoint. So really the recommendation or the suggestion from our side is to bring it down to a 5%. Straight away, that's 18% coming down to 5% is a straight saving. The sticker price comes down to that extent across the board. And it's also, a lot simpler from the point of view of execution. So my strong recommendation would be to not look at exemption, because that will actually increase cost, which is contrary to the purpose of, the discussion around GST.
Interesting times then for the insurance space. I'll tell you what, let's slip into a short break. But on the other side, we have Sudeep Shah and Mitesh Thakur who are joining in for a technical check on the markets. Stay with us.
Welcome back. You're with us on Bazaar Morning Call. Let's take stock of the market's trading setup now. We have Sudeep Shah of SBI Securities as well as Mitesh Thakur joining in. Gentlemen, hi. Morning to both of you. Mitesh, so it's been a week of consolidation on the index. Do you have a trade today for Friday?
Good morning. So I think, we were looking at a range of possibly 24,500, 800. And today, with the gift nifty indicating a negative setup, I think we might open below 24,500. And now we closer to the support pivots at 24,400, 350 zone. I think that 50-point zone for me is important. If we can manage to hold that band and bounce back from there, I think market should go back into some kind of a consolidation, and the fear of decline would possibly be postponed. But in case we start breaking the 24,350, then I'll be worried and look at a negative continuation on the downside. So in that sense, I think we'll take this call post the gap down. But my initial feeling is that we might be just be able to hold on to this 24,400, 350 zone and then try and attempt a bounce back from there.
Okay, got that. Sudeep, come in on the index trade for the day.
I also, good morning. I will echo with Mitesh that 24,350, 24,400 band would be a crucial support zone because both the 20-day exponential moving average as well as the 50-day exponential moving average is placed in that zone. And this zone, in case we are holding this, then once again the 24,300, 24,600 band would come into picture and markets would consolidate between that zone. So post the gap down, if the markets are stabilizing for the first hour or so, then there could be, say, a small buy trade closer to 24,400, 24,430 zone with a 50-point stop loss at 24,350 levels.
Okay. All right. Got it, gentlemen. So those are the index calls. Let's talk about individual stocks as well. Mitesh, what's your list looking like?
So I have a mix of buy and sell calls. On the buying side, with this gap down, NMDC is something which is of interest to me. I'll keep a stop below 234, look for a target in the range of 248, 250. Eventually, beyond these levels, even higher levels can be looked at. And Tata Communication also buy in this range of 1840, 1833. Keep a stop at 1809 and look for targets of 1910. Godrej Consumer is on the sell side. It made some continuation candlestick on Friday, so could see price levels of 1065. So short here with a stop at 1131, and Coal India is a sell with a stop at 414 for targets of 397.
Okay, got it. Thanks for that, Mitesh. Well, Sudeep, normally I should get your calls. I recall a couple of years ago on HTR, middle of the day, but now start of the day itself. What do you have for us?
Morning, Nigel. One buy and one sell. The first one, which is on the buy side, is in HDFC AMC. The close is around 45.40. We feel that here there's a lot of consolidation that has already happened in the last 1 month, and this stock is now very close to its intermediate swing resistance, which was around 4,500, and has closed above that. I feel from the current levels, 44.80 would act as a support. The stock could be bought with this stop loss at 44.80, and on the upside, 46.30, 46.70 are the levels I'm eyeing for in the next couple of days. The second stock is BHEL, which is there on the sell side. A lot of selling pressure has been witnessed in these select PSU names, and post the pullback from the lower levels, now the stock has been facing resistance closer to 253, 255 levels on the upside. Last 10 to 12 sessions, the stock has not managed to cross that, and yesterday we have seen some kind of a substantial decline, and the stock is closed below its 20-day exponential moving average also once again. On the longer term charts, lower top, lower bottom formation is evident here. So I feel one can sell this with a stop loss at 251 for the downside targets of 236 and 232 levels.
Okay, all right, gentlemen, thanks for the calls. We will come back to you closer to market opening. Need to take a quick break right now, but on the other side, we'll have the pre-opening rates. Also, we get chatting with Sandeep Agrawal, fund manager at Sovilio Investment Managers, talk about the trends in the IT space.
Welcome back. Just awaiting the pre-opening rate should kick in anytime now. The Asian market picture is weak. The GIFT Nifty was down 100 points, but it looks like the opening on the Nifty pre-open is more on the flatter side, slipping a bit now, 35 points lower on the GIFT Nifty. IT has been very, very resilient. The Nifty IT index has clocked in a gain of more than 5% so far this month, and some of the IT names are again higher. TCS, at least in pre-opening, is the top gainer. Reliance Industries too has a positive tick. Siddharth Khemka still with us. Siddharth, any year-end ideas? Any top picks for 2025? You're in mute.
Yeah, sorry. So we did come out with some of these interesting ideas towards the end of the year, and we'll be definitely coming out with a list of top picks for 2025. But to just give out few names, the jewelry retail segment is something that we have been very positive on. We have been bullish on Titan for a very long time. We have been positive on Kalyan Jewelers for last couple of quarters. We have recently initiated coverage on PN Gadgil, which is the second largest jewelry retailer in Maharashtra with 48 stores across 21 cities. We expect that the company is likely to expand not only in Maharashtra but also in the neighboring states of MP, Bihar, and would be a key beneficiary of the ongoing shift in the jewelry retail business from the unorganized to organized and largely towards the nationalized player. Also, the company has seen sharp increase in its contribution from studded jewelries from to almost 7%, which it intends to almost double by next year to 15%, which should add to the overall margins. In terms of financials, we are projecting a 23% revenue and about 36% PAT growth through the store expansion, improvement in the unit economics, product mix changes, as well as efficient sourcing strategies. Valuation-wise, very comfortable compared to some of the other peers like Titan or Kalyan. Hence, we believe that could be a good stock to be with in 2025. And we have a target price of 950 over there.
Okay, all right. I just think in the near term, Siddharth, today I think there are a few, 30 lakh shares that were locked in, which can be sold, so that could be a bit of overhang just in the near term. So we'll keep an eye on that. By the way, Siddharth earlier told us that, IDBI Bank, it had corrected from around 110 to around, that 80 rupees odd mark. And maybe in the near term, that divestment news could keep the stock a little bit excited. So I guess the volumes are rather high in pre-open as well. So keep an eye out on that one, IDBI Bank. Sapna had got some news information yesterday. Siddharth, I wanted to ask you about the OMC space. The last quarter was weak. Quarter 3, though, should be blockbuster. Looking at the marketing margins and all, it's much better than what we have seen in the last few years on an average. So Street could be bracing for a very strong set of numbers in quarter 3. There are risks that come with it, but what's your view?
Yeah, Nigel, I think definitely if you look at Q3, refining margins, especially Singapore refining GRMs have improved to about $5.2 per barrel compared to about $3.6 per barrel in Q2. You look at the MS, HSD marketing margins that have remained robust. They have improved in Q3 to about 13.6 rupees and 10.7 rupees respectively, while what we were expecting is about a 3.5 rupees per liter for the next few years. So definitely based on what we are seeing the current trends, we expect OMC's EBITDA could see a sharp rise of almost 60 to 80% on a sequential basis. Q2 versus Q3 versus Q2, we could see a 60 to 80% rise in EBITDA for the oil marketing companies, plus lower inventory loss sequentially both in refining as well as marketing could see a bumper quarter for oil marketing companies. What we like HPCL, which is our preferred pick among the OMCs. We have a target price of 470. Some of the additional triggers that we see catalyst for HPCL is the demerger and potential listing of the lubricant business, commissioning of its bottom upgrade unit in fourth quarter, as well as the start of its Rajasthan refinery in the Q1 of FY26. So all that put together, we believe oil marketing companies can definitely see a strong momentum going on from here.
Okay, all right, got that. Good to have you on the show. Siddharth, have a good Friday to the 13th, and we look forward to meeting you again soon. Well, with that, let's move on and put the spotlight on the IT space. This segment of the market has done fairly well in the last couple of weeks. We have now with us Sandeep Agarwal joining in. He's fund manager at Sovilio Investment Managers to give us a sense in the outlook for 2025. Sandeep, great to have you on the show. I was just going through the highlights of a Citi note that has come out specifically on Infosys, and Citi feels that Infosys is finding some green shoots now, and discretionary spends are picking up in the BFSI space, particularly in the US market. But you tell us, what's the overall trajectory? There's a lot moving with the Trump presidency, but purely in terms of demand, how will next year be for some of these larger firms?
Hi, good morning, and thanks for having me on the show. So, the way I look at it, obviously, with Trump coming in, and if the economy in the US picks up momentum, any which ways, that, today for growth, you need technology infrastructure and spend on technology because most of the things have moved towards digital. So obviously there will be a big delta there, and many people who have been holding back on discretionary spend because of the impending US elections earlier, they may, open up now more. The only thing which I believe needs to be taken care of on the cautiousness side is that remember that Trump is coming and he knows who is making how much money and all that. So there could also be some kind of cost which can come for doing business there. So although there is no alternative to Indian IT because we hold almost 96% of the pure IT services market, which is outsourced if you exclude the BPO part. So we have definite monopoly on the scale and everything, but still you never know. Politicians can do some arm twisting. So right now we are only seeing the positive part of it, but there should also be some cautiousness on if the cost can go up for execution.
So what's, after this 26-27% kind of a year-to-date rally for IT stocks, what's the broad call? Do you think 2025 will hold moderate returns, for the sector per se? And if you had to pick one stock where the growth is the highest and the risk-reward is reasonable, which one would it be?
So I think, and we have done this interaction several times in the past. Last year was the time when there was maximum pessimism when offered letters were withdrawn, variable pay were postponed. I think that was the bottom, and we have said that whenever this has happened, and this keeps happening every 3-4 years. Funny part is that whenever offer letters get withdrawn or variable pays get postponed, that is the bottom of the industry because corporates only go by data, and when these things are happening, that means data is at the bottom. So that is the time when stock should have been bought, and we have seen almost 40% run up from there. In my view, now the returns will be commensurate with the surprise in the earnings growth and not with what it is there. So I think the surprise in earnings growth, 2-3% revenue growth surprise and 5-6% earnings growth surprise is what is left, and some re-rating. So I would agree that there is moderate return going forward, although the numbers will surprise positively a little bit on revenue growth and more on the margins. But because multiples have already re-rated, you will not get any delta on the multiple side from me. On stock, we run a PMS and we hold few of the tech names in our portfolio. So very hard to comment, but I would say that the inexpensive large caps would be the ones which you should have a look. I think telecom has not done well for quite some time. So company with higher telecom exposure, product engineering exposure, those are the ones which will do well. Also in the mid and small cap, although the multiples may look very expensive for ER&D, I think ER&D can open up in a very big way. Remember, 3-4 years since Ukraine crisis happened, the ER&D space has not done to its potential. So there could be a big delta there in the ER&D space. So although some stocks are expensive in that space, but that space can open up in a big way.
All right, and the two ER&D players would be KPIT as well as Tata Elxsi. Both of them have come up from the top. So between the two, what is the preference?
Again, hard to comment on preference, but I would say that any R&D company should do well for next 2-3 years, because if you see the data last almost 1 year, R&D companies have been struggling a bit, and for no reason, because demand is very strong. There are some Ukraine war related issues, some visa related issues because of which this is happening. I think 10 years there is a structural bull run in the R&D space. So the multiples may look expensive, but for a long-term investor of 3 to 5 years, you will make phenomenal return in any of the good R&D companies where quality of management is good.
Okay, so ER&D is looking good, but just to round it up, Sandeep, what you're saying is that from an investor perspective, that play has already happened, ER&D, with the stock price appreciation, right? So you're saying you would rather look at large cap IT at this point?
So I'm saying in IT services, I will look at large cap IT services with exposure towards sectors which have not done well, like telecom and product engineering. And in the mid cap, I will look at ER&D plays where even multiples are higher and they have run up, but there is a long delta there for next 3 to 5 years at least. So in ER&D, I will play even expensive stocks, but in IT services, I will play large cap, which are reasonably priced and exposure to telecom and product engineering.
Okay, got that. So ER&D, you're willing to pay more because you see that growth runway ahead. Got it. Thank you very much for joining in, Sandeep. Always good to have that perspective. Great to have you on this morning. Have a good rest of the day. Okay, we need to get back to our market experts as well. The pre-open is suggesting about a 50-point downward start, which is not too bad, considering a lot of markets in Asia are selling off for over 1%. So this is looking good, I mean, if it's this much. The bigger question is, will the buyers come in? Because the market's consolidated. We haven't rallied at all this week. So can there be some buy the dip sort of a trade playing out? Let's go back and ask Mitesh, actually. Mitesh, what is your advice? Just revisit the index call and also any fresh stock ideas.
On the index, my big support band is between 24,400, 350 zone. So would want to buy around those levels in case we get some kind of support there. And on the stock side, NMDC would recommend buying with a stop at about 233.5, 234 for targets of 248.
Thank you. Let's get to Hormuz now. There is an upgrade on IOC. Hormuz?
Jefferies has upgraded Indian Oil to a buy and a price with an earlier rating of hold. They've raised their price target as well slightly to 185. It was 165 earlier. That's a 31% potential upside from yesterday's closing levels. Now, what Jefferies is saying that Indian Oil is the largest beneficiary of improved refining margins as they expect it to improve in 2025 going forward as well. And that is because it has the highest refining to marketing volume ratio among its other oil marketing company peers. Now, the stock of Indian Oil has corrected significantly from its peak, and as a result of which Jefferies believes that the risk reward is favorable. It is now trading at a 70% discount to the Nifty compared to its historical long-term average of around 57%. So Jefferies finds risk reward favorable, hence the upgrade, the raise in price target as well, and the stock likely to open higher today as well.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's hop across to Vivek to tell us about HAL as well as L&T. HAL is one of the top gainers, I think so.
Well, that's right. Very interesting development and very important development as far as HAL as well as L&T are concerned. This is news that's coming from the Defense Ministry. The Ministry of Defense have signed a contract worth 13,500 crore for procurement of 12 Sukhoi aircraft. So with this large order of 13,500 crore, HAL's YTD order intake as far as the manufacturing segment is concerned stands at 39,500 with the remaining quarter and a half well poised to go ahead and meet the stated guidance of the company. Now coming to L&T, once again the company has received an order for manufacturing of 100 K9 self-propelled howitzers. The likely order size over 7,500 crore. With this order, again, that gives further comfort to the analyst community regarding the 10% year-on-year order inflow growth that the company has guided for at the start of FY25.
Okay, all right, got it. Vivek, thank you very much for that. So those are some of the stocks that we will keep on our radar. Just to go back to the screen, 50 points lower with the Bank Nifty in step with the Nifty. That's what we're looking at least at this point in time. Talking about some of the key movers and shakers, what the pre-open is telling us. The weakness could perhaps come in from the metal names, and that's not a surprise because China once again has disappointed, given that there are no specifics in terms of their next round of stimulus. The week is ending, we're none the wiser. And therefore, the disappointment is playing out in the Chinese market, Asian markets, and, metal stocks are a pull from there. Then there is Titan, IndusInd Bank, Kotak Mahindra Bank. These are some of the other weak hands as well. In general, bit lackluster, and we need to see how things progress. Keep an eye out on Zomato as well to see if buyers come in. The news is negative. This 800 crore rupee, little over 800 crores of, tax notice, penalties, etc. for the last couple of years. That's what the, taxman has served them. But the question is whether the dip is going to be bought or not. Just a couple of seconds left to go. And all the indices are going to be starting about 0.25% on the lower side. Okay, so exactly what the pre-open was indicating, about 30 to 40 points lower. That's what the Nifty is doing at this point in time. Mid-cap index is falling a little more, 0.3%. The Bank Nifty is very, very flat. So this start is actually not bad. given the sell-off on Wall Street, given the sell-off in Asia, India is actually outperforming. It's not bad. If it holds here or if it picks up from here, then it'll work well for the bulls. Just to talk about where the weakness is, like we've been saying, metals, JSW Steel, Tata Steel, Hindalco, all down. And a couple of big boys like Infosys, Reliance, ITC, they have started off on the negative side of the screen. But Nigel, let's see if this dip gets bought. Now it's only a 30-point cut.
I mean, sometimes you have a surprise on Friday the 13th. Could that be the day? The queue is stacked up against the bulls, or maybe they want to fight back. I think the crucial level that needs to be held out is 24,400, 24,450. Let's focus on some of the top volume movers today. DCM, that stock is up close to around 12.5%. So, it appears the street is quite excited on that one. HAL, should be mentioned. I think that one, in fact, is moving very, very well. So, good uptake is what we're seeing on that particular name. ITI, well, its move back to its winnings ways has been very, very volatile all of this week. But that stock as well is higher. Swiggy, swigging it away, up close to around 2% as we speak. Lemon Tree Hotels as well, one of the top volume movers. That as well is moving higher in today's trading session. We had Niva Bupa. A few sessions ago, the stock just went up like a rocket one way. But now, in fact, it's cooled off quite a bit. We had the management who joined in on the channel, and in fact, they sounded quite optimistic. But that stock is pulling back still, another 2% or thereabouts. NMDC as well has a good run of late, but that stock, in fact, is a little bit lower. Nalco, keep an eye out on that stock, as I mentioned earlier today. Yesterday, it fell on some negative news flow, but maybe there was a bit of an overreaction on the downside just in the near term. And now the stock is in the F&O band, so it can fall only if there is cash market selling, not fresh shorting. For the time being, that's one of the few metal stocks that are mildly, very, very mildly in the green after falling 8.5% yesterday.
Well, some more. IOC, where Hormus was telling us, Jefferies has upgraded IOC and put a target price of 185. Risk reward is favorable. The stock has moved up and opened up with strength, 1.7% higher on that. GR Infrastructure, it's an order win to the tune of 107 crore rupees. EPAC Durables, it's been one of the big movers, from its IPO that happened, earlier this year or last year. So EPAC Durables, DAM has initiated coverage. They've put a target price of 495 on EPAM. And I think the kind of growth expectations, so they're saying revenues are likely to see a 42% CAGR over FY24 to FY27, stable margins, and a profit growth of 50% over the next 3 years. So very strong visibility for DAM on EPAC Durables, and that stock is higher in trade. There's another small company called Bajal. I don't know if I'm pronouncing it right. Bajal Project, that's one in order. So that's higher by close to about 6%. Zinka Logistics, earlier known as Blackbuck, recent listing, reports numbers today, and that it has opened up in the green. Some buying seen in hotel names, so Samhi, Chalet, higher in trade. On the losing side, we spoke about softness in many of these metal names, so SAIL, NMDC under pressure. You also have weakness coming through in Zomato. Zomato is down 1%, even as Swiggy is higher in trade.
A big battle between the bulls and the bears on the large cap screen right now. Couple of banks like ICICI Bank are pulling their weight on the upside, but then there are others on the downside as well. So it's absolutely flat on the bank nifty. Some buying in auto names, very few small names here and there, like Tata Motors, for instance. iSure is up about 0.5% as well. But yes, it's a weak start to trade. There's no two ways about it. Let's see if we can go across to our market master of the day, Pankaj Tibrewal. He's joining in now. Pankaj, great to have you on. Always a pleasure to be chatting with you. So, it's interesting. The market's gone through this 10% correction, and now it's kind of settled into a consolidation band. So much is going on around us, right? From geopolitics to tariff talk to major interest rate action. We're awaiting the Fed next week. And a change of guard at our own central bank. So given the extent of news, information and noise, what do you expect? More consolidation? But is the downside intact? I mean, have we made our lows, at least for now?
Good morning, Surabhi. If you look at this correction has been a very healthy one. Though we are down about 10 to 11% from the peak, but index actually masked the damage. When we were looking at about 4,600 stock universe, and about 75% of that is down by more than 20% plus. And even we have seen cuts of 30, 40, 50%. And many of those stocks have not still come back even markets have recovered a bit. So I think over the next 12 to 18 months, we should look at range-bound markets, maybe 22,500, 23 on the downside, because earnings would provide some support, and probably 25, 25 and a half on the upside. And within this band, I think stock picking will be rewarded. And what we are seeing is that the breadth of the market is getting narrower and narrower. The style shift has started to happen. Last 3-4 years was all about momentum, beta, value. For the last 6 months, what we are seeing post-election is quality is making a comeback. We are seeing growth getting rewarded again. We are seeing low volatility outperforming. So I think style regime change has also started to happen. Also, we don't forget from a macro perspective, first half we have seen a severe slowdown in the economy and led by various factors which have been spoken about, like government expenditure being slow. And don't forget this year, in the first 7 months, government met just 42% of the target. This has been the lowest since 2010. And hence we saw a severe slowdown at the ground level. Going into the second half, our sense and the feedback from the ecosystem is that the things have started to improve, and probably government expenditure from the last quarter should actually pull up the economic parameters, and the high frequency indicators have started to suggest that. However, my only worry is that the expectation of the street for FY26 earning growth is still on the higher side at about 15 to 16%. And I think in the next 2 quarters, still street will readjust its earnings forecast for next year. In our sense, it will be about 10 to 11% earnings growth. And hence market returns will more be a function of earnings growth. Last 4 years, we compounded at 20-21%, and markets clearly reflected that momentum in earnings. If earnings growth is slowing down, probably we should also moderate our return expectation. And hence, we believe that last 3-4 years have been extremely charitable. There was no differentiation between luck and skill. And I think now it will be men versus boys as you move ahead into the next 12 to 18 months.
Well put, Pankaj. Now let's get to the actionable ideas for 2025. This is Reema here. In an earlier conversation, you had spoken about being positive on insurance. But now increasingly what we've picked up, CNBC-TV18 has learned from sources, is that IRDAI has flagged concerns about this over-dependence of insurance companies on their bancassurance platforms, and the stocks have been under pressure. Pull up an SBI Life and HDFC Life over the last couple of days. Are you still bullish on insurance? If this happens, if the IRDAI takes some measures to, address this concern, will it hurt insurance? Does it change the thesis?
No, Reema, it doesn't change the thesis. The runway for growth from an insurance perspective is very long, both on general as well as life. These disruptions will keep on happening from a regulatory angle, but all these companies are very, very strong, and the growth opportunity is very large. If we get opportunities at lower levels, this is one sector where we should be positive on in the BFSI segment. And also the financialization of savings. We have seen how exchanges, RTAs, depositories have behaved over the last 1.5, 2 years. They have given phenomenal returns. And we believe that in the BFSI space, now there are enough options rather than only depending on banks, whether private or public. You have insurance, you have capital marketplace, you have NBFCs, and a whole plethora of other related activities. And hence, I think that the weightage of BFSI in any portfolio compared to 5-6 years back is not only dependent on banking, but the entire lot. And we continue to remain positive on banking and financials. And within that, insurance, capital marketplace are our preferable place, preferred bets. Also, from a 2025 perspective, couple of sectors which are looking probably interesting and maybe contra at this point of time. One, I believe, is cement. I think the worst in cement is behind us. The benefits of consolidation has not been seen. And then this level of profitability, Reema, it's suicidal to put incremental capacities because you are earning 5-6% return on capital. Entrepreneurs are better off parking that money in fixed deposit rather than going for expansion. Hence, our belief is that profitability has to improve to justify new capital expenditure in cement sector. And that's one area over the next 24 months which can show momentum as you move ahead. The second, I think, is metals. It's a complete contra thought, but we believe that the contribution of metal sector to the overall profitability pool in the country is back to 2001-2 levels. And that's an interesting space to be in because two of the largest economies in the world will have a fiscal loose policy. US on one side and incrementally China on the other side. So our belief is that this sector is under-owned and probably incrementally you could see momentum getting developed on commodities and metals as a sector. And the third is specialty chemicals. For the last 2.5 years, we have seen the sector seeing downgrade in earnings cycle led by slowdown destocking. I think we are coming towards an end, probably in the third or the fourth quarter. And our sense, meeting so many companies and the entire ecosystem, is that the worst is behind in chemicals. And probably in the next 2 years, the earnings CAGR in this sector is likely to be higher than the earnings CAGR we have seen in the past 2 years. So I think this sector could also find favor among investors as you move ahead once investors start seeing growth in across the companies in the sector. So these three could be the contra bets as we speak. Otherwise, consumption has started to look interesting. It's a K-shaped recovery. It's a mixed picture, but I think valuations have started factoring in a lot of pessimism. And in certain cases, we believe on the consumer discretionary side, there is some interesting bets emerging. Even on the staples side, after the correction, what we have seen, we were looking at our numbers, and on a FY27 basis, many companies have started to look a bit attractive, assuming a normalized consumption scenario over the next 24 months. So this is how we should be positioned moving into 25 in terms of our sectoral preferences at the margin.
Very, very interesting calls, Pankaj. I think I'm going to remember all of them or most of them. Just for the benefit of our viewers repeating, what you're saying is that three contra sectors look very interesting. They have not performed so far, but you will watch out for steel, metals, overall, cement and chemicals. And you're also looking at opportunities maybe in consumption. On consumption, Pankaj, elaborate a little more because it's a very confusing picture. And I want to understand when you're saying that, yes, obviously stocks have cooled off, these, FMCG, large FMCG companies. But then how much are you willing to pay and what is the kind of growth you're penciling in? I mean, there's a debate saying whether for 5-6% kind of volume growth, whether you should be paying top dollar. But you're saying valuations have become comfortable. Just give us some numbers. Growth and the PE that you're okay with.
So let's look at consumption into three buckets. And I believe that we will make a mistake if we look consumption as an aggregate part. So there is India 1, which is the top 10% of India, where the aggregate per capita is about $10,000 to $12,000. And globally, if you look at, once you cross that $10,000 mark, your expenditure on grocery basic necessities flatten out. And you don't spend more on that, you spend more on experiences, other discretionary. And that 10% is driving the Indian consumption. The next 30%, where the per capita is between $3,500 to $4,000, is the aspirational India. If you provide them with right quality products, right pricing, they are there to lap it up. And many companies, for example, Judios, Trent, some of the other names, have addressed that part in the tier 2, tier 3, tier 4 cities, and they are seeing phenomenal growth. And the rest 60% is between $1,000 to $1,500 per capita. They are struggling because of inflation, because of EMI, because of many other things. And the stress is visible if you look at the data of MFIs or FMCG players, which are catering to the basic needs. Our sense is that if you focus on the top 10 and the next 30% of India, which is India 1 and India 2, and companies which are doing brilliantly out there are those companies which are catering to those two sectors. And our preferences in consumption that don't paint the entire sector with the same brush. Have stock, which could cater to India 1 and India 2. And I think your portfolio should do well. On the other side, when I look after the correction now, a lot of companies probably have come to about, between 35, 40 times earnings in FY26 or FY27. Some of the FMCG names as well. And we are pricing and penciling in the worst of consumption basket right now. However, if you look at the ground level, the rural has started to pick up. The commentary across rural, whether it be two-wheelers, whether it be tractors, have been positive. And many of the FMCG players also have started talking about rural being positive. So I think if you move into FY25, 6 and 27, I think consumption basket as a whole should start showing momentum. We are seeing at the worst pricing. And overall, my sense is that this sector is no longer uniform. You have to pick right companies, right sector, which are catering to the right audience, and hence you will not get disappointed. So our sense is that we are very stock specific in this sector, but this is an interesting opportunity where many consumer names are coming between 35 to 45 times. And when I look at the other sectors, relatively speaking, which are B2B, they are trading at that valuation on a FY26-27 basis. So I think some incremental positions could start to build upon. And don't forget, Surpi, good prices, good news don't come together. So quality companies during bad times have to be looked into. And some of the value retailing guys are looking good. Some of the consumer discretionary names are looking good. And maybe after the correction, some of the FMCG names will also start to look good. So that will be our approach towards consumption.
Very interesting. So that becomes a bit of a fourth contra call, if I can call it that, because not too many on the street are willing to stick their neck out right now in favor of, bread and butter kind of consumption. Very interesting and golden words there, right? That great earnings and great stock prices rarely come together. So yeah, something to think about. Well, fantastic conversation as always, Pankaj. Thank you so much for joining us today. And in case we don't speak till the end of the year, wish you a very, very happy new year in advance.
Same to you, Surbi, and same to the entire team of CNBC-18 and all of US. Happy New Year.
Thank you. Thank you so much. All right, let's move on. Quick glance at the market before we move on to our next discussion, which is a very interesting one. The cut is, as of now, a little deep. 24,400 is under question. So let's keep an eye out on this. So far, no one's venturing in to buy that dip. There is overwhelming negativity in global markets, so no one's trying to do brave things early on. But let's see, it's a long day ahead. We'll figure out how this goes. As of now, market is under pressure. But moving on to another interesting discussion, and it's all about insurance now in our next conversation. The CNBC-TV18 news break has been confirmed. The insurance regulator is indeed considering to tighten norms to cover over-dependence on the bancassurance channel. To talk about this, we have with us industry veterans. We have Mr. Nilesh Sathe, former member of the Insurance Regulatory and Development Authority of India, or IRDAI. We also have Rajesh Sood, managing partner at Tisaya Partners, and he's the former executive vice chairman and CEO at Max Life Insurance. Thank you, gentlemen, so much for joining in. So it's a big debate that was stirred up when I think the finance minister made that first statement saying banks should look at their own business, which is banking, and now not look at selling insurance policies that people don't really need. It all started from there. And then now we know that the regulator, industry regulator, is also looking at it quite closely. So, Mr. Sathe, your first thoughts, this whole dependence on the banca channel, whether it is the parent bank or whether it is some other bank that you're tied up with, it's the way in which the industry has been built for the past many decades. Do you think there's a need to change? Is it the time to change this?
No need to change it. Actually, if bank can promote insurance company, nothing wrong in that. And those who have promoted insurance companies have really done well. Even their earning ratios are quite satisfactory. Means whatever capital they have invested, they have got good return on that. We have seen it getting reflected in the share price of these companies which are listed also. So I am not of a view that banks should be asked to stop doing insurance business, but it should be properly regulated. It is definitely not properly regulated today because when finance minister herself has said that mis-selling complaints are increasing in case of bank assurance, means they are definitely on the rise. And it has to be seen what are the reasons for this. If at all some corrective action is to be taken by Reserve Bank of India, they should take. If IRDA has to take it, they should take. And one thing which is certain, that over-dependence on one channel is always is never good. So it is necessary that there has to be a spread, because insurance is ultimately spreading of risk. So this principle applies everywhere. You should not be over dependent on one channel. So IRDA may definitely take some action on this. A couple of them may be. I'm not sure whether they will take these actions. Asking the banks which have promoted life insurance company or general insurance company not to get more than some specific percentage of business from of that company.
No, absolutely, absolutely. So, Mr. Satay, we'll come to this. What can be maybe, you know, a middle path which is palatable and not totally disruptive. We'll come to that in just a minute. Let's also get in Mr. Sood's thoughts into this. Mr. Sood, now you've been a practitioner within the industry as well, right? Technically, one can argue back, our colleague Yash was giving us the data. Technically, if you say, mis-selling in FY23 as per IRDAI's annual report was just 0.09%. So technically, you can say that I didn't, you know, make a false statement, so I've not mis-sold. But that's not the point. I think the bigger debate is that whether there is so much pressure in terms of selling and the fact that a lot of this is dependency on banks, that whether the policy buyers' actual interests are being served at the end of the day or not. It's a larger debate, I think, that the finance minister has kicked off. So your sense on whether there needs to be a rethink on this dependence on the bank channel and the way policies are being sold?
Thank you. I'll actually answer it from a couple of perspectives. So first and foremost, I would fully endorse the fact that banks everywhere in the world, and particularly in India, I think have tremendous access to customers. They have the widest distribution, and therefore utilizing the channel to spread insurance to cover people is absolutely the right thing to do. And that's what the industry has evolved to see as well. So I don't think there's any going back on the importance of bancassurance as a channel of distribution. The second piece, I guess, that we are referring to here is what is the right way of selling it, and is dependence on only one, let's say, bank partner or a bank promoted partner issue, so to say. I would also argue from a business point of view, it's actually an individual company's strategy. And to some extent, there should be a degree of freedom allowed to that. If somebody believes that they can do well with their incumbent partner and that's all they want to do, that's their choice. Now, risk, yes, there is a risk of dependence, but then that's for the shareholders and the board of that company to manage, of course, within the overall ambit of how the industry structure is evolving in India. Now, thankfully, there have been, over the years, so many insurers. There are almost 30 each, I would say, 25 in life and about 30 in the general insurance and SAHI combined, that it's not as if there are only a couple of insurers who are dominating this whole distribution channel. So there is, I think, a large kind of play out there where banks can choose and have chosen in the past to go with single insurers or multiple insurers. So that's, I would say, a matter of company choice. The last thing, I think, which is the most important piece that you bring up, is where we should talk about what is that particular way in which this governance can be tightened. How do you ensure that customers, when they interacted with banks, or for that matter, any distribution partner, feel that their interests are being taken care of, believe that there was transparent disclosure, that they were not being pushed into a product, but rather they were actually explained what the features were and why it's important. And, I think the often quoted thing, everybody needs insurance, but nobody wants it. That's the so-called conflict that we have to resolve. How do you kind of move it from that, need to want, is the selling process. And it's there, I think, a lot more emphasis, both in terms of practices, in terms of target setting, in terms of incentives, in terms of repercussions in case found to be missold. Those are the dimensions, I think, that need more work.
No, absolutely. I just want to refer to the numbers that we're flashing on our screen as well. And these are really important numbers to understand why stocks get jittery every time this is brought up. Because let's pull this up. I mean, the share of bancassurance for an insurer like HDFC Life is 65%. For SBI Life, it's 58%. So they're getting this much of their business relying on the bank channel. And which are these banks? A large part of it is the parent bank in these entities. So 95% of the bancassurance in SBI Life's case is coming from the parent bank, State Bank of India. Likewise, for HDFC Life, it's about 80 to 85% is coming in from the parent bank. The exposures are slightly lower for the others like Max and ICICI Pru. Mr. Satay, now let's come in on the point of what thresholds can be, sort of prescribed. What will the industry be okay with? Because, why should we ignore LIC? LIC has built its entire business on a very different model, on the agent model, not relying on the banca channel as per. And that's also a discussion ongoing, whether that should also be opened up. One agent should be able to sell multiple policies, just like the mutual fund world. The MF world is not that heavily dependent on the banca channel. And a mutual fund distributor can sell all kinds of funds. So, should this also be considered for insurance?
Two questions. One is on what we call as open architecture for individual agents. And the other is to what extent the parent bank should be allowed to sell the products of the banks, products of the insurance companies, which are promoted by them. As far as heavy dependence on one insurance company is concerned or one bank is concerned for insurance company, both is harmful. But then it should not be reduced to 50% overnight. They should be given some sliding path by way of which they should be asked to reduce it maybe by 10% every year, so on and so forth, up to 50%. IRDA has already allowed insurance companies to tie up with 9 life, 9 general, and 9 health insurance companies. But they have not made it compulsory. Even when it was increased to 3, it was not made compulsory. Initially, most of the banks used to tie up only with one insurance company, but now many have started tying up with more than one. The purpose is the customer should have an option to choose between at least 3 insurance companies, the product that he wants to buy. Now it is increased to 9. But there is no compulsion. There is a possibility that the IRDA may ask these companies to compel, these banks to compel, to be compelled to have tie-up with more than 3, so that the sliding path of share of one insurance company will come down. So this is a possibility. Second is, we have to understand why is it that the banks are over-enthusiastic in selling insurance products and not mutual fund products, because both are financial products. And the most important, probably the reason appears to be the amount of revenue that they get by selling insurance products, because insurance being a push product, higher rate of is there and higher base income is generated. So obviously they are more keen on selling it. So targets are given, whether targets should be given.
Absolutely, sir. And that is the entire framework that is up for debate today. Rajesh, last word with you. We only have 30 seconds left. Give us your prescription, something that you think will work for the industry as well, and start meeting these larger objectives, that questions that are being asked in terms of selling the right product to the right customer and not pushing beyond a point. So what is the threshold? Mr. Sathe said that, say, if you say that the parent bank contribution should not be 50% and you bring it down to 50% over a couple of years, is that something that's palatable to you? Just leave us with the specifics. What should be the percentage? How many years should be given to come down to it? And also this thing of tying up with multiple insurers. A bank should have, 5 insurers, 6 insurers. What would your recipe be or prescription be?
I certainly would advocate multiple insurer tie-ups. That for sure is something that I believe is healthy, because it promotes competition within the industry as well and certainly offers choice to the customer. But the second part, I think, is where I would emphasize that how is that choice being offered to the customer needs to be worked upon. Today, actually, there is no check back on whether a customer was given an option or not. So maybe from a conduct point of view, I would think some more areas, like we have an illustration as an example, which the customer is kind of required to sign and receive. So again, is there a necessity to show at least 2 products which are competing in the same genre of whatever the customer is wanting to buy? It could be one way of looking at how do you really bring choice to the forefront rather than it just being a theoretical construct that there is choice. That'd be one option, I'd say. The other would be, I think, and some work has already begun on that, which is back-ending the reward structures, where instead of a lot of money being, let's say, upfronted, there's a little bit of move now towards having more renewals and trail-based income, and that improves persistency for the industry. It's great for the customer. It's good for the distributor. Obviously, there's a change management piece there, but I think that's already begun, and maybe that needs to be accelerated a bit more. That will also take away some of this overly, aggressive pushing that might happen for front-end sales. And the last, I would say, I would be careful about prescribing any percentages on what should be the number. But as Mr. Sathe also said, I think a pathway, a gradual way to kind of comply with a certain diversification norm should be the way I would say it. But remember, some of these companies have also formed joint ventures with banks, and there was obviously some commercial consideration given for that. So that all will need to kind of be allowed to play out so that nobody feels that this was a late stage change of their structure. So I think those would be the 3 things that I'd say.
Okay. Gentlemen, thank you very much for joining in. Very interesting discussion. And I think this topic is going to come up again and again. For now, we'll slip into a very short break. On the other side, we'll invite the management of International Gemological Institute. Their IPO opens for subscription today. They're looking to raise 4,225 crore rupees. So we'll get discussing with the top management. Welcome back. You're watching Corporate Radar. Now, International Gemological Institute, IGI, the company which certifies natural diamonds, lab-grown diamonds, jewelry, studded jewelry, colored stones. Their IPO opens today. The company is looking to raise 4,225 crore rupees. The price band will come up for you on your screen, 397 to 417 rupees. Now, globally, IGI is the second largest independent certification provider. Their market share stands at 33% as of 2023. Just yesterday, the company also raised 1,900 crore rupees from 68 anchor investors at the upper end, 417 rupees. And some of the investors include Government of Singapore, ICICI Prudential, Axis Mutual Fund, Abu Dhabi Investment Authority, and many more. Temas Printer, MD and CEO, and Ishwar Iyer, CFO of the company, are now with us on the show. Gentlemen, thank you very much for joining in.
Thank you.
Thank you. So, Temas, if I may, start with you. Now, this IPO, the fresh issue is done so that you can consolidate even Belgium and Netherlands into India.
That's correct.
Now, once that is done, what would be the company's volumes, market share globally, and the financials?
Okay. So, first and foremost, let me tell you this, that IGI is the first gemological laboratory to go listed. In the world, not India itself. So that itself is a benchmark. After it's listed, what happens is all the three verticals of IGI gets consolidated into one unit. And whatever you see from our figures, we can only go forward. And with after Blackstone has acquired IGI, it has been a different upscaled company today. In a very short duration, Blackstone has managed to transform IGI into a global entity. And we are here today to answer all your questions. I have Ishwar with me.
So, Ishwar, you want to fill us in with the numbers. Yeah. What would the consolidated global entity now look like? And what is the growth projection?
Yeah, see, so as I was, it's in the document as well in terms of to what Temas just mentioned. We have three entities, which is an entity in India, we have an entity in Netherlands, and an entity in Belgium. So we operate in close to 8-9 countries across the globe. So it's a geographically it's a very diverse organization that we have. The pro forma financials which are there in the document, our EBITDA margins are close to 56% for the 9-month ended September. And so that is the way it will turn out to be when the consolidation happens as well. There are not too many intercompany eliminations, etc. that we need to do. So the pro forma financials, the way they stand today, is representative of the post acquisition.
And growth rate at the top line?
At the moment, we are growing in excess of 30% in India. For the 9-month ended, we are on 30-31% growth. I think the key driver of the industry today is the lab-grown segment. So that is what is really propelling the industry forward. And it's a new entrant in the industry. It's been there for last 3-4 years. So we expect this to it's just a starting point, because most of these diamonds today are exported to the US. US is the largest retail chain in the world. From that context, this is scaling up in the US markets now. And once it starts hitting the India markets, there's acceptance to this a new entrant in India. I don't see any reason why this should not be the case. The growth should not be the case for the future as well.
All right. Hi, gentlemen, and welcome to the show. I'll tell you about both the ladies in the studio were quite excited. They were talking plenty about diamonds from the time the show started at around 8 a.m. So we're looking forward to chatting with you all.
Okay.
Now, looking at you.
Certification is important, right? We know we're buying. We want to know we're buying the right thing.
Both are diamonds, by the way. Exactly the same.
I guess, yes, we're aware.
So let's talk a little bit more about that then.
All
I'm
right.
looking at the way your revenue mix has changed. Lab-grown was mid-30s, which has gone closer to around 60% or thereabouts. It seems because of the pace of growth we're seeing out there, it'll constitute a larger proportion of your revenues. But what about margins? What's the difference between all three of these? Lab-grown, studded, as well as natural. Is there a margin difference? If yes, what is it?
See, let me put it this way. Overall, the margins have been at 66%, which has now grown to 72%. So that itself is an indicator of how the thing is going. Natural is unique, rare, and expensive. And where lab-grown is concerned, it's more affordable.
Correct.
Right?
So for you, where do you make more money? Or is it the same?
We make more money from the volume aspect.
Okay.
And we make money from the unique aspect. So it's an overall mix. And we make money on diamonds and gemstones. See, we certify diamonds. We are a neutral body. We are an independent neutral body, which gets audited by ISO and RJC. RJC is the Responsible Jeweler Council, which looks into the ethics of the business. And of course, ISO looks into the compliances and standardization of our grading model. Okay, so we are a third-party certification, and we get certified, audited by a third party.
No, what we're trying to understand and get at here is that lab-grown is increasing. The share is increasing.
Yes.
But it's a lower margin business.
Right.
The other business, which is natural, was a higher margin business.
Right.
So from our understanding perspective, how much is the gap in margins? If you could even give us ballpark numbers of how much is the margin for natural versus lab-grown.
Okay. So again, let me take that question. While we don't try to distinguish between the the margins for each of the categories, but what is relevant, and to the point that he mentioned in terms of the acceleration that we are seeing in the lab-grown segment, which used to be around 35-36% of the revenue mix, today is close to 60%. So while natural diamonds, to what Temas just mentioned, is unique and it's not a volume game, but lab-grown diamonds is far more is a volume game because it's man-made, it's machine-made, right? So from that context, the volume synergies that we get in lab-grown is what is driving the EBITDA margin improvement per se.
So going
added to the fact that structurally, we have been always grading natural diamonds till the time lab-grown made its entry in the last 4-5 years.
So you told us blended margins were 56% as of 9 months, calendar year 2024. So even as the contribution of lab-grown continues to go up because of higher volumes, will you be able to maintain margins between, say, 55 to 60% going ahead?
Yes, of course. And in fact, it could go a little higher. Essentially, what happens is lab-grown is a new kid on the block. Okay, it is just starting off. And it's a very affordable diamond. The consumer pie, which is very small from a global population point of view, is fast expanding. The millennials and the Z generation, are doing all the research, and they find out that both are exactly the same. So, come on.
So as volumes
keep growing. Yeah, exactly. We're not arguing that point.
Yeah.
Definitely lab-grown diamonds are going to grow.
Definitely.
What we're trying to understand is, even with volumes picking up on lab-grown, whether you will maintain this margin profile of 50 to 55%.
See, we are so well entrenched in the manufacturing and polishing sector. India polishes 95% of the diamonds which are exported for the global market. Okay, and we are right there in the marketplace. So we are very strong on that. Plus, I mean, natural diamonds are a little bit on a low ebb currently because of the war in the Ukraine, and 30-35% of the rough for the natural comes from Russia, and there's a little embargo on that. So hopefully the war ends. Every business goes through a little
Cycles.
up and down, and lab-grown is taking it up right now.
So, Ishwar, just one quick question. I think Temas started by saying that Blackstone has transformed the company in the last 1.5 years, in a very short span. They entered in May 2023 at a valuation of $570 million. In 1.5 years, the valuation has swelled to $2.1 billion. What changed in the last, what is it, Ishwar, that they have done?
Just before Ishwar answers, Ishwar is tantamount of the fact that he joined the company 1.5 years ago. He's the global CFO. Now we have a global CMO. We have a global CHRO. You understand? We have SAP introduced into our organization. You understand? There are so many different things that has evolved the company to a global level. Now, Ishwar, please.
Yeah, so just to add on to what Temas mentioned, I think the point that's what we need to, just to put it in perspective, is the fact that India is the manufacturing hub for the globe. Yeah, that combined with our presence in key markets, be it the US, be it Europe, be it the Middle East, be it China, Hong Kong, there is a lot of synergy that is there in the group today. And the philosophy that we are adopting now, is the one IGI philosophy. These businesses, the way they have evolved over the last 50 years, have been running as individual profit centers, which no longer is the case. Because the strength of manufacturing in India combined with the strength of retail in the other geographies that we are present is what is probably going to propel this business forward. I think that is the key element in terms of the philosophical change or the thought leadership that is now emanating within the organization as a group today. So I think that is the key change from a leadership perspective standpoint. I think that has been one of the key drivers that Blackstone has brought on the table, which we are obviously in the midst of executing. We've made some leadership changes in the US, etc., which is important because we want to get some people who are therefore able to grasp the importance of the change that's happening in the industry, and therefore, enabling the growth momentum to continue.
All right, gentlemen, we appreciate you all joining in. Wishing you all the best for this IPO. Today, we're letting you all go away without too many numbers, but on listing, we're going to ask you what are the projections going ahead. But interesting business, and we look forward to being in touch.
Thank you so much for having
us
here.
All the best.
Thank you very much.
Okay.
All right, time to move on then. The 10th Motilal Oswal Annual India Ideation Conference will take place next week. To talk about their conference and how will the Indian market perform in 2025, we're joined by Rajat Rajgaria, the Managing Director and CEO at Motilal Oswal. Hi, Rajat. Good morning. Good to speak to you after a while. Well, Rajat, tell us first, before we get to this conference, how are you feeling about 2025? Most on the street are suggesting it's going to be more of a difficult year. Do you think likewise, or do you think the recent pullback has provided some cushion that maybe 2025 will not be as bad?
Well, I think 2024 itself has not been bad. If you look at the large cap index for the year, it's up about 13-14%. Mid caps have done quite well, just that while they had a pullback, but they do allow some room for markets to catch up as we see more triggers. So I think 2025 should be a good year, decent year. 2024 has been another good year. We see no reason why things should not move up from here in 2025.
Okay. Rajat, hi. Morning. Great to be talking with you. So expand on that a little bit, because there is this whole debate raging on possible slowdown, just when rural is picking, urban is slowing, inflation issues here in India, whether the RBI will cut as much as the market wants or hopes. What makes you optimistic about 2025? And from a market return standpoint, is it going to be a 10% year? Could it be even better than that, lower than that?
Look, markets are definitely rallying around earnings. If you look at earnings, the moment August, September onwards, we started seeing slowdown, cut in the estimates. You saw pullback in the markets. I think where we stand today, 2-3 important trends are there. We definitely see the interest rates being a lot accommodative in 2025 from the beginning of the year. Come Feb, we do expect some policy changes to happen. So that provides a momentum for the rest of the year. Second, I think we have started hearing a lot of chat around government spending now picking up. That had its own share of impact on the slowdown, I think, in the first 6-7 months, that hopefully should catch up. And I think third, on the consumption side, the base has become low with inflation moderating, with these 45, 50 lakh marriages happening, some amount of pickup is likely to happen. We are already hearing that at least this December quarter is just a little better than the September quarter. And I think a lot of the estimates, both at the macro and at the corporate earnings level, that had to moderate has been done. So a lot of these things have got priced in. To your point on what 2025 should be, I would think at the broader market, a 10, 12% kind of a year is good. But as last 3 years we have seen, it is a very bottom-up market right now. Pick up earnings which are growing, pick them at right valuation. There's a lot of money that people are still going to make.
Rajat, you said that December earnings are already looking better. At least what the early channel checks seem to be suggesting compared to the September quarter. So what have your discussions with corporates, investors thrown up in terms of the December earnings season this time? What should we expect?
So, if you look at September quarter, a lot of the consumption category companies had a negative volume growth from a low single digit to high single digit. I think at least December quarter, we are looking at that trend to at least get better to more like a neutralish kind of a quarter. In some pockets, you may see some volume growth coming up. Plus, I think globally, if you look at whether it is oil prices, other commodities, they have been very ranged to soft. And plus, if the government spending picks up, that is also going to make the entire cycle look better. So I think September was really a very, very tough quarter. In that context, December is likely to be better.
Okay. Rajat, so let's talk about then the themes that you would be most optimistic on going into the new year. Is it going to be more of the same, more of the capex and the manufacturing related plays, or is it a good time? We were just speaking with, by the way, Pankaj Tibrewal a while back. So he was talking about a lot of dark horse sectors. Just for your reference, he was saying watch out for the underperformers like cement, metals, even chemicals. So I don't know if you share that view or not. Basically, themes for 2025.
Every year at the beginning of the year, people do expect that a lot of the things that didn't work well last year, if any of those underlying business trends get better, stocks do make a big comeback. Last 2 years, we have seen how capex over consumption has performed. I think similar themes will be sought after in 2025. But I think three themes that as a house we are very positive on. First, capital markets. You guys would have seen we released a big report early this week with a coverage on companies across the value chain. I think this is not just a 2025 theme. This is a theme that you can play for 1 year, 3 year, 5 years. And this across space, right from an AMCs to intermediaries to other depositories, look fantastic. Second, I think as you start seeing the rate cycle becoming more accommodative, you will start seeing financials, more particularly banks, and in some case, private banks, which will make a comeback. Consider that last 2 years, they have really not contributed much as a space. So your theme of both underperformance catching up and plus a very reasonable earnings growth at a very reasonable valuation makes them worth. And third, I think capex remains a theme because 18 months back when we had written a report, we had spoken about that as a 5-year theme. I think we are still into an early cycle of that. This cycle is only going to get better and stronger as the economy picks up. So these remain our three top-down themes, and there are multiple stocks within these three themes to play for.
Okay. All right, Rajat, we'll leave it on that note for this morning. Thank you very much for joining in. We'll take a break right now. On the other side, we'll have Mitesh Thakkar joining in for some technical ideas. Stay tuned. Welcome back. We've got Mitesh with us now to take a couple of calls. Mitesh, so the market's had a quiet morning and it's kind of drifting lower. What's the advice now? Index and stocks.
Yeah. So I was talking about 24,400, 350 zone. We are right there, but we haven't got a signal of reversal. So I'm not going long on the index and hoping that we don't break below 24,350. Then I think we'll look at some downside continuation. So for the timing, holding our horses. But on the stock side, I have one buy and one sell. And technology remains the bright spot. So TCS is a buy. Keep a stop at 44.15. Look for targets of 45.25. And AB Capital on the other side is breaking down. So sell here with a stop at about 187.5 for targets of 185.
Okay. All right. Got that. Thanks very much for the calls. We'll connect with you a little later during the day. Right now, we'll take a break. Coming up next, our special segment, it's the economy. Lata will be chatting with Abhishek Upadhyay of ICICI Securities Primary Dealership and Upasana Bharadwaj of Kotak Mahindra Bank to talk about the November inflation print.